Hello and welcome back to another video. In this video, we're going to do a stock analysis of a company that belongs to the steel industry. And just like me, maybe you also have a negative bias against investing in companies that belong to cyclical industries. And the reason why I wanted to do this is to go one layer deeper and understand why that cyclicality exists, if at all, why we have that negative bias, and maybe through the example of this company, we'll be able to understand the industry a little bit better. Later on in the video, I'll also share with you a video, a lecture by two of the very well-respected investors, and hopefully that can also help you get a deeper layer of understanding in investing in cyclical industries and companies. Now, before we proceed with the video, I have a simple request. Our goal is to get to 2,000 subscribers, hopefully over the next 3 months, and I need your help for that. So if you like anything about the video, please feel free to click on the subscribe button, and more importantly, please share it with other investors who might benefit from videos like this. As a general disclosure, I want to make it very clear that the sole purpose of making this video is for educational purposes only. I am not invested in the company at all. Now, we're going to do the stock analysis of a company called Godavari Power and Ispat Limited, which is a steel manufacturer. And as we do this stock analysis, I want to start right from the beginning, because any business is basically a 3-step process. To make it very, very simple, right? Any company will source a raw material, it will convert that raw material or add value to that raw material to create a final product, and then it'll sell that product into the market, right? So in order to do the stock analysis for GPIL, let's start off with the first step, which is the sourcing of the raw material. And for a steel company, the primary raw material is basically iron ore and coal, right? Thermal coal. And there are other raw materials as well, such as manganese, limestone, XYZ, but the primary ones are iron ore and coal. Now, iron ore is basically an ore which is mined from the surface or the crust of the earth. And there are also different types of iron ores, and depending on the chemical composition of the ore and depending on the Fe content that is there in the ore, there are categorized as different types. So for example, there are the 4 main types of ores are magnetite, hematite, limonite, siderite, and they all have different compositions of iron content in them. And magnetite, which is basically the higher Fe content ore, is not as easily available in India. It is available, but it is not as easily mined compared to hematite, which has slightly lower Fe content, right? And the Fe content for magnetite can go up to 72%, and hematite can go up to 70%, right? But I use the word up to because the composition can be slightly lower as well, right? So these are basically the ores. Now, the company has 2 mines that it owns in Chhattisgarh, and the type of ore found in Chhattisgarh is mainly hematite ores, right? These 2 mines are Ari Dongri mine, which has a capacity of 2.35 million tons per annum, which is basically 23 lakh ton per year, right? And the second mine, which is the Boria Tibbu mine, is a much smaller mine. Again, the same is in Chhattisgarh as well, which is 0.7 million tons per annum. The reason why I mention that this company has its own mines is because it becomes extremely important in a business like steel, where the cost is a very, very important part of the whole game. And because the company has its own mines, it doesn't have to rely on buying iron ore from the market. It doesn't have to be exposed to the demand and supply, and therefore the huge variations in the prices of iron ore. Now, both these mines, Ari Dongri and Boria Tibbu, are roughly around 166 kilometers to 200 kilometers away from the Siltara plant that they have, which is an integrated steel plant of the company, right? And the reason why I mentioned the distance is because logistics cost is a very, very important element in the whole game. Just to give you an idea of how important it is, on your screen you can see this is basically a screenshot from a draft steel policy on basically improving the logistics dynamics for the steel industry, right? And as you can see on the screen, you'll notice that steel and iron ore freight contributes 12% of the total freight movement in the country, and their logistics cost, the inbound and outbound combined, is roughly 16 to 18% of revenue, right? Which is a huge amount, right? Now, of course, it can't go to zero, but even if you compare it with the benchmark, the best in the world is somewhere around 10 to 20%. So the government is also trying to focus on the logistics and kind of, get that logistic cost down. So logistics are an extremely important factor in the steel industry, right? The other two, and by the way, this reflects in the numbers actually, the backward integration part. The way it reflects on the numbers is, again, this chart that you can see. If the company was to source iron ore from the market, look at that black line, right? The spread between what it costs from its own mines to source the iron ore versus if it was to source it from the market, look at the huge variation, right? So between 2020 and 2022, the gap was really high, where if the company wanted to source, it would have to pay 7,800 rupees per ton, whereas the same iron ore it was able to source, because it has its own mines, at 2,900. And this shows up in a big way in the numbers as well on the income statement, where you can see the gross margin has basically expanded from nearly 31% in 2016 to as high as 56%. Right? So those are the kind of advantages you get when you're backward integrated, and this obviously flows down into the net profitability as well, which we'll see in just a minute. Now, once this iron ore has been extracted, it is filtered, sorted, cleaned, and then transported all the way to Sildara, which is where the actual steel making happens. Now, steel making is basically taking the iron ore from around 60 to 70% iron content, removing the impurities, and getting to 90 to 92%. And this form of this concentration of iron, this is basically called pig iron. So that is the next step in the steel making process. In order to get from the iron ore to pig iron, there are multiple steps, but mainly this happens via the blast oxygen furnace method or the electric arc method. Now, I would not be the best person to explain how this process works, so I'm going to show you a very nice video by Thyssen Group, which is basically a European steel manufacturer. And over the next 2.5 minutes, you'll get a very clear idea of how this process works.
Our iron and steel mill is like a giant machine. We produce flat carbon steel here around the clock, 365 days a year. This requires iron ore, coal and other raw materials delivered by ship or rail. The coal first enters the coking plant and is baked at a high temperature for 25 hours. The resulting coke is cooled down with water until it is hard and porous, just right for the blast furnace. In the sintering plant, fine iron ore is prepared for further processing in the blast furnace. Extremely hot air is used to cake the iron ore into coarse lumps in the sintering process. Now the smelting can begin. Iron ore, coke and additives are continuously filled into the blast furnace from above, up to 25,000 tons of material per day. Hot air at 1,250 degrees Celsius is blown in from below. This leads to complex reactions at high temperatures. The oxygen is removed and the ore is reduced. As they melt, the various components move steadily downwards, resulting in molten pig iron and slag. In the tapping process, the finished pig iron and slag are discharged from the blast furnace every 2 to 3 hours at a temperature of 1,500 degrees Celsius. The actual steel is produced in the melt shop. To make flexible, forgeable steel from the brittle pig iron, the amount of carbon must be reduced. This is done in the converter. Steel scrap is mixed into the molten pig iron. This environmentally friendly process is used for cooling. Oxygen is then blown in, which reduces the amount of carbon and results in crude steel. Not all steel is the same. Secondary metallurgy allows the chemical composition of the molten steel to be controlled with great precision. The steel is boiled with small amounts of chromium, molybdenum, or other additives to form an alloy. This process is used to produce some 2,500 different grades of steel.
Now, hopefully we've understood the process a little bit better, and just to summarize the entire steel making process, there's a diagram in front of you on the screen which shows both the blast oxygen furnace method on the left hand side, and on the right we have the EAF method. And as you can see, there's a word pellets, right? And I want you to remember this because in the next section, when we actually get to discussing the product mix of Godavari Power and Ispat Limited, things will become clear as to why we are discussing all this in a little bit more detail than maybe is required, right? So both ways steel is made. Steel is then made into, flats, longs, blooms, whatever, and then it's converted by the secondary steel producers into, whether it's auto parts, whether it's, guitar strings, whether it's stainless steel in the bottle, XYZ, right? So this is the entire process. And with this, now let's move on to the product mix, right? On your screen, you should be able to see that the product mix, as far as the revenue breakdown is concerned, 45.5% of the revenue, at least in the year 2022, came from iron ore pellets. And as we just saw, pellets are basically a pre-form of the raw material that goes into these furnaces, whether it's EAF or in the blast oxygen furnace, right? And pellets make up for most of the revenue. The remaining 55% is made from different forms of steel, which is MS round, sponge iron, steel billets, HB wires, silico manganese, right? These are all different forms that basically happen after the molten iron has been made, except maybe sponge iron. Sponge iron is also a type of raw material that goes into the EAF method particularly, right? So this is the breakdown of the products that the company sells. And to again add another layer of understanding, now let's actually look at what is the pricing for these products per ton, right? The reason why we want to do that is because it will tell us again where exactly in the value chain these products are fitting in, right? So if you look at it, at the top we have iron ore pellets, right? So INR per metric ton, basically the price per ton. In the first quarter of 2024, the price of iron ore pellets was 10,200. Now, in the first quarter of 2024, the iron ore price is somewhere around 5,000 rupees per ton, right? So it means that iron ore pellets are obviously a value added products, right? So we go from iron ore, which is selling at 5,000 rupees per ton, to iron ore pellets, which is around 10,200 rupees per ton. Then you have sponge iron, which is even higher value added, further down into the steel making process, which is 30,000. Steel billets are obviously, billets are formed after the molten iron is kind of cast into different shapes, which is the billet is a type of shape, which is 46,000. These round bars or TMT bars are basically 50,000. HB wire is 52,000. Ferro alloys, this is where we're getting into even higher value added. This is silico manganese and all of that, 72,000, 76,000, and these are different subsidiaries of the company. We go to 73,000. And galvanized fabricated products. So galvanization is basically the use of zinc, right? And that goes up all the way to 80,000. So it gives us a very good idea of the product range and where these products are fitting into the chain, right? And that's why the pricing is according to what it is, right? The next question we might want to ask is, where is the growth going to come from? Because this is the product mix, right? What are the segments? Which part of the value chain is the company focusing on in order to, create growth? And if you look at the production trends over the last 7 years, we're seeing that the company has focused particularly on the iron ore pellet side and iron ore mining. And one of the reasons why the pellets for this company are unique is, one, they have a higher Fe content, whereas most of the pellets in the market are 60 to 63% of iron content. GPIL's pellets are basically 65%. So they are unique in that sense, and therefore the GPIL pellets can actually command a premium of around 1,000 to 1,500 rupees per ton when they sell their pellets into the open market, right? So this production trend gives us a sense of where the company is trying to focus and get growth from. We've talked about the raw material sourcing, we've talked about logistics, we've talked about the entire process of steel making, we've talked about what products the company sells. Now let's see what it looks like in terms of numbers. Now, if we condense everything that we've learned so far into the financials, they look something like this, right? These are the financials for the last 10 years, and the four or five different segments where we're going to discuss is one, the sales number, particularly the highlighted part. The second one is the operating profit margin. The third one is how debt has reduced substantially over the last 4-5 years. And finally, the net profit. Now, a lot of industry analysts or industry players say that you should look at the EBITDA per ton number, and I agree with them. It is just that in this case, because there are many different products, and the EBITDA per ton for the entire business would not be as useful. So that is why I have not done that. But usually, that is one metric you should use to analyze steel companies, right? So we'll start off with the operating profit margin, but because this is the first place where the inherent cyclicality in the steel business actually shows up. And as you can see, there is a huge fluctuation in operating profit margins. Okay. Now the question arises, okay, why is it? What is it about the steel industry that makes these operating margins so so cyclical, right? What is the reason for that? And in order to understand that, we need to break it down into its subcomponents, right? So operating profit margin is a function of sales and operating expenses. Now, let's start off with operating expenses. Operating expenses are further, if you break them down, are a function of fixed costs and variable costs, right? Now, in a steel business, right, the fixed costs as a percentage of the total cost tend to be higher, so they have a higher fixed cost, whereas the variable cost could be logistics, could be maybe labor to some extent. That is relatively lower as a total percentage of cost, which means therefore you have a higher fixed cost business, right? So that's one. The second, which is not necessarily an operating expense but is more of a cost of goods, right, which is the raw material pricing, that is not in your control usually, right? So unless you're a backward integrated player with your own mines, you do not have control over the pricing of the iron ore, and you have to rely on the market prices, which can cause a lot of fluctuation on the raw material sourcing side, right? Now, when we come to sales, sales is a function of the value and volume growth, right? Value is basically how much you can get per ton of the product you've sold, and volume is actually the total tonnage, how many tons of steel product you're selling, 1 ton, 2 ton, 10 ton, 1 lakh tons, whatever, right? So that is the breakdown. Now, what happens is, when it comes to the realization is a function of the demand and supply of steel into the market, and neither of those are in the control of the company, right? Because they are external factors, and demand in itself for steel products is dependent on the four major industries, which is construction, engineering and packaging, automobiles, and the fourth one, I believe you should be able to see on the screen. So these are the four major industries that drive the demand for steel, right? And all four of these industries are themselves highly cyclical, right? So therefore the demand is cyclical, and therefore the pricing is cyclical, and therefore the realization per ton that the company is earning, it is not in the company's hands, right? Similarly, when the demand falls, the volume also tends to fall or follow along with the demand, right? So if we combine all of these elements, right, we find that the cyclicality is a normal part of the steel business, right? So that's the first part. If you look at the operating profit margins of the company itself, they are highly fluctuating between 10 to 20%. And recently in the last 2 years, they've gone as high as 35%. If we compare this with the operating profit margins of other steel players such as Tata Steel, SAIL, JSW, we can see that the cyclicality is there as well, but there are some players which are less cyclical in terms of less variation in operating profit margin, for example, Tata Steel. And I believe the reason for that is the large scale that Tata Steel has. And obviously, it is one of the lowest cost producers of steel. And then they also have their own mines, so they have that advantage as well. And you can see the fluctuation is still there, but it is generally in the upper range. So even though fluctuation has been there, it is above 20%, right? Whereas the other players are, as you can see on your screen, still varying. Another data point we can kind of get a sense in terms of the operating profit margin is if you look at all the companies above 1000 crore market capitalization, there are around 39 companies that I filtered out, and you can see that this current operating profit margin, which is of north of 30%, is highly unusual, right? There are very, very few companies, even amongst the pack of these steel companies, that make those kind of margins. We have GPIL, we have Raghav productivity enhancers, we have Technocraft Industries that are above 20%. We have Mishra Dhatu Nigam, and then we have another company which is I'm unable to see, Bharatwise, right? So these are different, those are the few companies that are able to earn such high margins, right? And maybe for a curious investor, maybe these can be companies that we can further kind of start looking into, right? So hopefully this explains the cyclicality inherent in the steel sector. And now the question arises, okay, if this is so cyclical, how can an investor potentially make money from cyclical industries? And this is where I'm going to share with you a link of the video. It should be on the screen. If you don't find it here, it will be in the description. And this is a video by two very, very well-respected investors, Mr. Nitin Dharmawat and Jitendra Parmar. And they have explained how to invest in cyclical industries like nobody else. And I think you should really watch it, and it'll add a lot of value in your investment process, right? So that's as far as the operating profit margins and cyclicality is concerned. The second thing we want to evaluate for GPIL particularly is how is it that the sales, right? Because the sales have done tremendously well from 2020 to 2022, right? And we want to use the knowledge we've just learned about what, sales, volume and value being what determine the sales. We want to understand, okay, what is driving this huge jump in sales? And if you look at the numbers, the total volume growth has not been so great, right? So from 1.8 million tons to 2.1 million, it is barely a 1.1% CAGR, barely any growth as far as the volume is concerned during these years. Then how is it the sales went from 3,200 crores to 5,300 crores, right? It is because of the value growth, right? Which is the realization per ton that the company could command in the market. And that is a function of the iron ore prices and the steel prices, which are generally market driven, right? We can see the cyclicality in terms of the iron ore prices, right? And we can see that in the last 2 years, there has been a sharp increase. This was probably because of the supply chain disruption because of COVID, and there were a bunch of factors. And this unusual pricing environment took place over the last 2 years, and therefore the company benefited immensely. And as a result of that, you can see that the debt has reduced substantially from almost 250 crores to down to 25 crores. And as of now, the company has no long-term debt on its books, right? As a result of that, profitability has increased. So when 2016 and 17 were where we had the lowest steel prices, those were the worst years for the industry, where the company made a loss of around 100 crores to 74 crores. That went up all the way to 14 crores. And proportionately, the amount of money investors who bought in the worst of times have been, really exponential, right? And this is again a lesson that you learn in the video that I'm sharing. So please do check it out, right? So as a result of all of this amazing performance, you can actually look at the return on capital employed as well of all these major steel players. And we can see that Godavari earned a return on capital of 51%, Shyam Metallics 28%, Tata Steel 27%, JSW 25%, right? Those are ridiculous numbers which have already come down from 2022 peaks. And it is almost for sure that these numbers are not sustainable, because if you look at the historical ROC of even GPIL, the last 15 years, you see that above 20%, it has, maybe done 3 years in the last, in the last 12 years. And then 2021 to 23, because of the reasons we discussed, the ROC has been very, very high, right? So this is where the company stands in terms of the financial results, and how the business model actually comes down into how it reflects on the financials, right? Now, the question is, okay, you've explained everything, the whole, process, we've looked at the financials. Now the question arises, okay, what are the risks involved in investing, for example, a steel company such as GPIL? And for that, I'm actually going to ask you to answer this question, because throughout this video, I have tried to share where are the uncertainties, where are the problems that can potentially crop up for a steel producer. And therefore, I want you to write in the description, in the comment box, what do you think, where is the risk for steel companies, right? So please share that in the comment section. And hopefully this video has been somewhat insightful. If you liked it, if you're still here with us, please subscribe to our channel and share it with other people. And with that, I want to thank you for watching. I'll see you in the